audience. Welcome to you all, whether you're in the room or whether you are somewhere around the world. I think we have something like over 100 people joining us, half of which are across the US, half of which are outside the US. For those of you who are joining us online, I should just say that you are very welcome. Indeed, you're encouraged to ask questions as we go along. Please use the Q&A tab that you'll find at the bottom of your screen if you'd like to do that. And if you're in the room, just put your hand up and we'll try to come to you as soon as we possibly can. When we last did this, which I think was in Miami in January, we had a lot of questions, I think a record number of questions from the online audience, and hopefully we'll get lots of questions again here today. Now, in light of the fact that we have a very impressive and very strong panel, I'm not going to give my, as advertised on the original invitation, a long introductory presentation. I'm going to hand over to the panel in a minute, but what I will just say to kick this discussion off and try and make it a little bit controversial at the same time is that we are at IFI Global just started to do some research on how tokenization is affecting real world assets in different asset classes. And we've been delving into areas at the moment, such as forestry, such as renewable energy, and also traditional energy as well, i.e. the oil and gas. And what's interesting, this is early days, so we may be coming to different conclusions in a couple of months' time, but what's very interesting to us so far is that the people who are creating the marketplaces in tokenization, in these very specialist asset classes, have got nothing to do with the traditional investment industry. And I wonder, and it's a question perhaps we can discuss as we go along today and in the future, is whether the asset management industry, when it comes to tokenization, is missing out. Of course, we all know BlackRock is doing stuff in money market funds. There will be tokenization of traditional equities. There will be tokenization of traditional fixed income, et cetera, But in the asset classes which potentially could have the most significant change through tokenization, we see, at least so far, a very surprising and interesting absence from the people who are known to the industry, the custodians, the asset managers, the usual suspects who make up the infrastructure of this industry. We don't see them in the areas that we have been investigating, at least so far. And that also applies to carbon credits as well, very much so, in addition to the asset classes I just mentioned. So that's all I'm going to say by way of introduction, other than to thank Jersey Finance very much indeed for sponsoring this event today. And I'm now going to hand over to Elliot Revson, who's the head of funds at Jersey Finance. And I've got this very high-tech device, which means that if I twist it that way, we should be able to see Elliot just from the side. There he is. That's not that's Chris, not Elliot.
That's a flat fun. Thank you. And thank you all for taking the time to join us today. My name is Simon Suggs, Elliot Refson. I'm the head of funds at Jersey Finance. A part of my role is to help shape the product offering of Jersey PLC, and the other part of my role is to tell people what that is. I'm just going to spend a few minutes to overview the digitalization of virtual assets, or tokenization, and frame how Jersey is positioning itself as a leader in this space. For context, over time, the way in which investments have been made has evolved steadily. They began with the introduction of railroads and industrialization in the 1800s. And from this, we saw the beginning of large-scale investments, which led to the introduction of stock exchanges to facilitate share trading. The first mutual funds came in 1924, modern portfolio theory in 1952, and more recently, we've seen the rise of ETFs and passive investing. Each era has brought new economic trends and investor behavior. Just to hone in on the investor behavior elements of that equation. Very recently, over the past 5 years, Jersey has seen a 50% decline in the number of collective investment funds, both in Jersey and in every other jurisdiction. This decline has been far more than compensated for by a significant increase in the number of funds of one and smaller commingled investment funds. The clear inference here is that investors want more control over their capital and investments. The tokenization of assets can help to facilitate this. It is an evolution, not a revolution, in the asset management space, as with any previous iteration that I mentioned. In its purest form, the tokenization of assets can simply be seen as automation. But what tokenization does is to enable a world where investments are more accessible, more transparent, and more efficient. And it is a sector, as Simon said, that's rapidly evolving and transforming traditional finance, both in terms of investment assets and alternative investment assets, known in this new era as real-world assets. Tokenization is seemingly giving the investor market what it wants. Earlier this year, a survey by EY Parthenon found that more than a third of institutional investors in the US and almost 2/3 of high net worth individuals plan to invest in tokenized assets by the end of 2024. This statistic highlights the growing appetite for virtual assets within the investor community. So let me take a moment aside to look at the history and rise in the popularity of this area. Virtual assets in the form of Bitcoin emerged over a decade ago as a revolutionary concept. These digital representations of value stored on secure online ledgers challenge the status quo of the financial system. Initially, these assets faced a lot of skepticism. However, their potential for innovation and disruption have become increasingly evident. Today, Bitcoin and other digital ETFs are established as mainstream. Looking at the traditional finance asset classes more widely, and according to a 2023 report by Northern Trust and HSBC, 5 to 10% of all assets are estimated to be digitalized by 2030. Established institutions such as BlackRock, Fidelity, JP Morgan, Goldman Sachs, UBS, and HSBC are actively exploring and implementing tokenization strategies. These firms are moving beyond operational uses to offer tokenized products directly to clients, indicating a shift towards integrating tokenized assets within their core offering. To support this activity, we are seeing the growth of the service providers. The law firms are establishing and growing digital fund groups. Administrators are establishing digital teams, and we are seeing the growth of platforms to support this activity. Similarly, alternative investment managers such as private equity and real estate managers are keen to participate. To look at why, the Bain Global Private Equity Report 2023 notes that individual investors hold roughly 50% of the estimated 275 to 295 trillion of global AUM, but that those same investors represent just 16% of AUM held by alternative investment funds. So this presents a genuine opportunity for alternative investment managers to adopt a holistic perspective on the market. In addition to the institutional investor market, it opens up to them the high net worth retail market with its significant potential for expansion and additional avenues of fundraising. That's to the tune of around $150 trillion. On the other side of the coin, this affords those investors access to new markets and new asset classes with potentially higher returns. So in reality, this is in effect the democratization of private markets, and whilst this enhanced liquidity might have beneficial ramifications, for example, consider the commercial real estate sector. I'd put a caveat on this scenario, being that increased liquidity does not necessarily equate to increased demand. A debt investment is still a debt investment, however accessible it may be. Turning to Jersey's position, from a jurisdictional perspective, the challenge always is the financial centres must stay relevant. Those who do not evolve to meet and serve the needs of the managed investors who use them and who do not reflect the advancements of their market simply die out. And history is littered with examples of that. As the virtual landscape evolves, the need for robust regulatory framework is crucial, and jurisdictions need to find a balance between fostering innovation and protecting investors. One key factor that sets Jersey apart from other jurisdictions is the almost unique and collaborative approach taken by our industry, our service providers, our government, and our regulator, which has for many years led to successful innovation. From the starting point back in the day, that Jersey would treat virtual assets as it would any other asset class, it was exactly this approach which led to Jersey regulating the world's first Bitcoin fund in 2014, which led to Jersey being the first jurisdiction to apply an AML control framework for virtual currency exchanges in 2016, and ICO guidance in 2018. It is this guidance which has been the facilitator of developments that have taken place in Jersey until very recently. In August this year, our regulator, the Jersey Financial Services Commission, issued two further guidance documents. The first is the tokenization of real-world assets, and the second is initial coin token offering. The latter being an update of the original ICO guidance from 2018. Both of these documents are aimed at supporting this new business in Jersey. With this framework in place, let me touch on the wider advantages Jersey brings to the table as a jurisdiction for the tokenization of real-world assets. In Jersey, our base case is stability, and that's both political stability and fiscal stability, as well as a minimal change outlook from a legal, regulatory, or economic perspective. And that's underpinned by world-class infrastructure. For example, we have the fastest broadband in the world, and by the broad and deep expertise of the 14,000 people who work in our industry. Jersey treats tokenization in the same way as securitization vehicles, and we have a long history of CLO and other securitization vehicles. Under Jersey law, securitization vehicle, and therefore tokenization in this format, is not treated as an investment fund and is therefore out of scope of the European AIFMD directive. In Jersey, customer due diligence is only required on the issuance and redemption of a token, and that therefore streamlines the process, eliminating the need for repetitive CDD for each transaction. Jersey does not impose a limit on the number of note holders, as some jurisdictions do. But most significantly, in Jersey, the regulator issues a consent to confirm the structure, which is a proactive confirmation that it complies effectively with regulation and brings with it a degree of certainty. In other jurisdictions, that reliance is on a legal opinion. And finally, in Jersey, there is tax neutrality. And it is for those reasons that I believe Jersey will lead the way in the tokenization of real-world assets. So in closing, let me stress my earlier point that the relationship between a jurisdiction and the managers they serve must be symbiotic. The jurisdiction must evolve to support the evolution of the managers and their industry. And from a Jersey perspective, we have done this and we will continue to do this. To quote our regulator, Jersey is open for new applications. And with that, let me now pass to Simon to introduce his panel.
Thank you, Elliot, very much. So with this swivel device, I'll start by introducing the panel to my right, so we don't have to swivel too much. On my furthest right, we have Christopher Griffin, who's digital assets partner at Carey Olson, who's over with us from Jersey. And sitting next to him is Kirti. Is that the right pronunciation?
Yeah.
Thank you. Good. Mugdar. Is that also the right pronunciation? Good. Thank you. Who's head of product at Onyx Digital Assets, which is part of JP Morgan. Welcome to you both. And then switching around here, we have Michael Oliver Weinberg, who is the adjunct professor of finance and economics at Columbia Business School. And on his left, we have Philip Pericki, who's lead Americas from Jersey Finance. And right over there, if you want to lean forward, if you don't mind, Eduardo, we have Eduardo Rodriguez Jr., who's the founder and CEO of Flatstone Capital Markets, who I think he's come the furthest today, because I would bet Vancouver, which is where he's based, is probably further away from New York than London. It's about the same distance. So welcome to you all. Thank you very much for joining us. I am not going to hang around. I'm going to get straight into the questions. I'm going to repeat, however, what I said at the beginning, to both to the online audience and to the physical audience. We do very much welcome your questions and interventions. If you're online, just use the Q&A button at the bottom of the screen. And if you're in the room, just put your hand up and we'll try and come to you as soon as we possibly can. So the first question I would like to ask the panel is, what is the most effective way to structure private fund assets on chain? Who would like to take that first? Anyone want to? Eduardo, why don't, because you're the furthest away from the thing, I'm going to give you probably, hopefully a bit more sort of airtime to begin with anyway. What is the most, because you are involved in trying to create a tokenization marketplace right now. So what is the most effective way to structure private fund assets on chain?
That's a great question. Thank you for having me here. And there's really, a number of legacy structures and best practices. And the way that I could define these from our perspective, from the Canadian perspective, which has already a defined regulatory framework, is that we're bringing some of the traditional finance best practices on corporate governance. How do you create the instruments, the actual funds, so that you can mitigate the risk? In our view, there is nothing new about tokenization, other than tokenization is the digital format that will allow us to represent real world assets. So in our perspective, actually today, when we look at the US regulatory framework, which we believe might change very soon, the proper way of doing the structured fund is basically follow. This will sound, again, redundant, but you have a number of best practices. You have, as you mentioned, a number of established players that have been doing these for a while. There is jurisdictions that excel at these, from very specific Jersey, other jurisdictions like Barbados, Bahamas, that have been doing funds forever. And everyone is thinking that if you use tokenization, you basically will solve everything through having a digital asset. Unfortunately, as we have seen over the past few years, if you do not basically continue to use the forms and the methodologies, if you, for instance, do not have the proper documents from inception, you will actually open doors for risk. So in a nutshell, I believe that using the proper legacy structures and the best practices that are used in Commonwealth, the UK and the US and Canada, is the right way to structure a fund.
Okay, thank you. Since this is pointing this direction, maybe I could come to you, Michael, and then Philip. Do you want to say something on this, Michael?
Yeah, I mean, I think we need the parallels with the existing regulatory regimes, and if this is to gain for more traction, because it's already gained some traction, we need to be comfortable in the security, the regulation, because right now in much of the digital world, in my view at least, there are practices that have long since not been allowed in the securities world. And for institutional investors, for them to gain comfort in these alternative structures or formats or vehicles will need, it's really crucial that the regulation and prohibitions on certain types of things are prevalent. I mean, after all, I think Eduardo alluded to this. I mean, to me, tokens are really just derivatives, right? A derivative is a security whose underlying, whose value is based on an underlying security. And by that definition, a token is just a derivative, and we have an immensely, hugely successful derivatives market that's burgeoned over the past couple of decades or more. So there's no reason it can't evolve that way, but with the proper guardrails.
Okay, Philip, would you like to?
Well, I think the guardrails are actually really important. I think if I'm not mistaken, Simon, I think we were in this very room probably 2 years ago on the subject, and we had people with pitchforks being very angry about the fact that just because the technology could enable broad distribution, that regulators might take a view on what's being distributed. And I do think that's ultimately, this is a very efficient way of structuring some of these products. But you still have to fit within a regulatory umbrella, because regulators have an obligation to make sure that what it is that you're selling into their market complies with the things that they're looking to sell. And as it happens, some of the nature of these products look very similar to securities, or look very similar to something else. And then the view typically is that you fall under that umbrella. So it's one of those rare cases where the market is looking for clarity. It's looking for certainty. You want the regulators to give some sort of clarity around these products. I think Elliot talked about this initially. I'll just take this because I'm actually talking from Jersey's perspective. I mean, Jersey's regulator took the position to say that we'll actually approve these structures. So you have regulatory certainty. It's clear that the regulators approved the structure. So I think this is one of those the evolution of this, or you're evolving alongside of these products, is finding greater clarity in what these products look like when you try to distribute them.
Okay, thank you. So switching around to here, Kirti, would you like to, because we're going to come and talk a little bit later on about exactly what you're doing, but in a general sense, have you got any sort of generalized comments about what is the most effective and what is the least effective, which is probably not discussed enough way of doing this? You've probably got some experience in seeing how it all works.
Yeah, well, I would definitely echo my fellow panelists. I think coming at it from the vantage point of JP Morgan, like anything that we issue onto our platform does need to fit and conform to existing legal and regulatory framework. That's part and parcel of the confidence that we're able to deliver out to our client base. And I think to one of the earlier points raised as well, sometimes it also comes down to like how much novelty are you introducing for an investor at any given point in time. Changing an entire structure and then changing the entire, not just operational structure, but also the legal structure as to how someone would invest into an asset is not something that at this time we see is where we want to necessarily push forward. What we're really looking to do is angle towards more how do you structure these issuances from an operational and technological perspective. So some of the questions that we ask ourselves, for instance, is, when you look across different jurisdictions, some jurisdictions allow for fund admins to directly leverage blockchain-based systems as their books and records. Others still require reconciliation back to traditional systems. Like that's one of the questions that we grapple with, and it's less so again around the legal aspect, though that's obviously guiding the decision, and more so comes into play with to what degree am I actually leveraging this technological tool to max out the operational efficiencies I can gain from it. So that's kind of the vantage point that we come out when we think about structuring and how it's applicable to tokenized funds.
Thank you. And lots of discussion of regulation so far. And so now we get to the lawyer and therefore the expert on this particular topic.
I mean, just dealing with the first question about, the most efficient way to structure blockchain-based fund, blockchain-based asset vehicles. I think, you know, from a, yeah, I'm a lawyer, so when someone says, what have I got? If I've got a token, what have I actually got? Because when I was an investor in a hedge fund, I knew I had shares in a Georgia or Canadian company, I could redeem them, all of those rights, I got, you know, my name is on the register of members, etc. What now suddenly I've got this token, what is that? Is that a share certificate? Is that an extract from a share register? You know, what is it? So I think you need that legally needs to be addressed when if you're an investor going into one of these funds or vehicles, you need to know what you're actually buying. I mean, leaving aside the advantage of distribution, etc., you need to know in the jurisdiction in which that token issuing fund or vehicle is domiciled, what do I get? You know, what is my token as a matter of law? Where's the legal opinion? I think the elephant in the room is slightly the crossover between tokenization and fractionalization of ownership. Now, this is a discussion around alternative funds, alternative investment funds. Those are sophisticated funds, yeah? People writing big tickets. This is not sort of widows and orphans. And I don't yet think that regulators are ready. Regulators have this sort of schizophrenic sort of attitude to blockchain, because on the one hand, they're being told by their governments, you know, we've just got a new government in the UK, Keir Starmer. He's telling everybody that, you know, notwithstanding Brexit, you know, London's going to be a centre of financial markets in the world, and blockchain will play a big part of that. And everybody goes, yeah, great, digital economy, you know, market leading, etc. And the regulator, not just in the UK, but elsewhere, is then, well, hang on a minute, you know, we could have a situation where, you know, highly unsophisticated investors are suddenly buying tokenized assets for which they are not yet ready. So regulation always lags innovation in the financial sector. I mean, I think it's Elliot was talking about the Industrial Revolution. In the early days, I read history at university, I didn't read law. In the early days of the Industrial Revolution, people were raising capital in 19th century Britain to build railways. And some of the ideas about railway lines and branch lines were completely ridiculous, and yet people were putting in money. And as a result of people losing their money, regulation caught up. That's why we got the London Stock Exchange, basically. Regulation will catch up with blockchain, digital asset, crypto, whatever you want to call it. But I don't think the absence of any kind of clear regulation is at the moment an inhibitor to it.
Isn't.
No, I don't believe so.
Okay, we are going to get into regulation a little bit later, so I do have some questions to ask you on that.
Bring it on.
One of the many reasons I love doing these things, you know, here we are talking about tokenization, and then I'm back to 19th century, you know, railways in the UK. That's exactly as it should be. Oh my God, I've just looked down. There are already 3 questions, so keep them coming, keep them coming. I'm going to ask my next question to the panel. I'm going to survey what these questions that the online audience is putting in are. The question I'm going to put to you all is, how is private funds assets access to capital improved by tokenization, and what is the potential over the next 3 years? And there's lots of talk on that, and Elliot in his introductory comments quoted research that's been done. There's been a lot of research done on how this is really going to explode the asset base in so many different asset classes. Being a little bit of a skeptic, perhaps by nature, it's difficult to see it yet. I'm going to come to you, maybe if I may, first. Because this is what you do probably all day long every day. Is how is this going to really grow capital in the private asset space.
Yeah, definitely. And I think you might actually have another question.
We've got
around this for me
more
later on,
questions,
but I'll
right.
keep it a bit shorter. So I think what's interesting, because you touched on fractionalization, and I think if you like Google tokenization private funds, like the first thing that always comes up is like tokenization will like democratize access to private funds. And I think that's not necessarily true unless we like unpack that a bit further as to how exactly tokenization could improve access of capital to private funds. So I think I think it touches back on what Chris had mentioned, but we think, when we think about alternative assets issued in tokenized form, that doesn't inherently mean that rules around like investor accreditation or the profile or the diligence process that needs to take place on investors goes away, right? All that it means is that you now potentially have, depending on how you've technically structured your asset, a more effective means of record keeping shares of that asset and then potentially utilizing those shares in downstream sort of ecosystems. And a downstream ecosystem could be, secondary trading, for instance, or lending. And I'll get back to the access point in a second. Those downstream opportunities are also not ones that are just purely enabled by tokenization, right? Like there needs to be actors in the market who are open to the ideas of trading private fund shares in a secondary capacity or lending against private fund shares. That's not just a technical problem. That's also one around investors coming to the table. But what we do think is that tokenization at least reduces the operational burden of enabling those types of opportunities. So like said very simply, if something's a little bit less hard to do, maybe there's more people who would want to do it. And similar, like playing on that same vein of tokenization being a means to like, first and foremost, like automating how you record keep an asset and automating how you interact with that asset. The other sort of opportunity that we see with respect to access to capital is being able to introduce alternative assets into other forms of other access points that investors typically engage with when deploying their capital. So a project that we had done late last year explored the concept of, if there are, I think it's like 80 trillion is what we quoted, $80 trillion worth of high net worth assets, and only 5% of those assets are invested in alternatives today. What's a means of introducing more of that capacity into the alternative space? And so what we looked at with our private bank and with a few of our partners was very much, the idea of, or the construct that exists today of a lot of high net worth capital being deployed through the model portfolios, which don't today have really an allocation towards the alternative space. So another angle to this question of access to capital for private funds, we think could be introduced by enabling tokenization to bring down the operational complexity of utilizing alternative assets within model portfolios and therefore improving the amount of capital that flows through to them. So lots of different angles, but in our mind, it all comes down to increasing the utility of the share as well as decreasing the operational complexity of like accessing the share.
There's one question that's come in, which is kind of roughly on what we're talking about. So I'm going to read it out and then turn this the other way. But if you want to come back to it, we lots more to go through, so we'll have to keep cracking on. This question is, we have not yet seen any fund managers reporting significant increases in assets because of tokenization. Why is that? Interesting question.
I'll start with that. First of all, I haven't seen the statistics and I don't know the numbers, but assuming that's not untrue. Look, institutions are by definition institutions. And as Kirthi just pointed out, private wealth is fractionally allocated towards alternatives relative to institutions. So alternatives are quite mature institutionally. However, in private wealth, they're quite nascent, and the growth in alternatives will clearly come from private wealth, so private wealth is, again, they're barely allocated to all, so this is even further out, tokenization, so that's, you know, way down the road, we're in the sort of first, second inning, and that's the, I don't know, seventh, eighth inning. And then for institutions, you know, I mean, it's risky at many levels, again, right, as we have been discussing regulatorily and for other reasons, it's unproven, no one wants to be first if it, you know, look at FTX, even though that's a different thing and an outright fraud. But again, institutions are averse to taking risks and being first movers. There's comfort in doing what other institutions do and others aren't doing it. And again, if it blows up, then your CIO, or rather, if you're the CIO at an institution and it blows up, your board says, why would you do that? It's so obvious. Look at FTX or look at this or that. So, you know, it'll be the proverbial chicken and egg problem, I think, in terms of institutional adoption. It will take a while, is my view.
I don't know whether who sent that in is right or wrong, but it's true that there's hugely bullish reports all the time, which again, some of which have been quoted here this morning or this afternoon, or whatever time it is, about what's going to happen in the near future or the further future. But what's happened to date, i.e. up until whatever day it is in October, isn't that impressive. Is that correct, Eduardo and Philip? Do you want to make any comment on that, or?
Absolutely, yes, and thank you. You know, chiming on the comments related to these question, I think from our standpoint, we see it differently. There is a number of misconceptions. So not everyone is JP Morgan and has the ability to hire the best in class. Not everyone has the ability to understand technology. We have been dealing with regulators and bringing the best experts, some of them who work with Goldman Sachs, JP Morgan and company to Canada. And even though when we have a regulatory regime that supposedly allows you to do these things, the regulators by definition are extremely chiming to the lawyer on the table. They are extremely conservative. And when you think about, again, what is an institution, for instance, myself coming from the Royal Bank of Canada or TD, you have a business that is working and we call it the cow that continues to give you milk. So if these animals still gives you a great amount of yield and your business is anchored around that, and let's be honest, most of the people in the banks, I was just talking to one of the members and the guest that is sitting in the room. I had a call a few months ago from I won't mention it, but it's a big four. And this gentleman said, look, you need to help me to sell this to the senior partners. And I said, well, that's your job. Why would I help you? Right? And he said, well, you know, it's just that they're afraid that they're going to lose their book. And the reality is that there is so much misunderstanding. And this is why clear rules and these regulatory paths in the US has created a lot of problems, especially, for instance, us, we see it in Canada. Even the biggest players do not want to, because they have operations in the US, they're extremely risk averse and they don't want to do it. And so unless you are a huge institution like JP Morgan or Goldman Sachs that has more money than God, then you have the ability to basically mitigate that, because what happened with FTX is really that's the elephant in the room. We have a group of whiz kids that said, oh, let's tokenize everything, let's digitize, and it's good. And what we see from our perspective is, if you do not keep the proper forms, going back to the first question, well, you know, a bad business that is digitized is even worse because it's transparent and it basically allows everyone to say the king has no clothes. So we go back to bankers are bankers, we speak banking language, technology people speak technology, and lawyers speak regulation. And most of us think that we are the center of the universe. And when you have that mentality, no one's gonna try to play nice. Everyone thinks that, hey, my business is well, so I'm gonna continue doing it the way it is.
That may explain why in my opening comments, so far, we've gotten to the research we're doing. We're not seeing any of the names you'd expect in these more interesting asset classes. They don't want to do something stupid and get splashed across the FT or the Wall Street Journal with something. Philip, do you want to comment on this before we go on, or?
It's actually something that Chris said earlier, and also Kirti pointed out, which is that, in order, regulation lags technology. Kirti brought up this sort of increasing utility and reducing the burdens and the friction. And I actually, there's another component to this, which is its broad application in the market, its actual use cases. And just as a sort of, for framing, my first experience in being on the chain was smart contracts in about 2015 with an insurance product. There's an indexed insurance product that we were developing that couldn't really function if you had human interference or involvement because the cost was too expensive. That product was way ahead of its time. Even today, it's still too far ahead of its time. Not just from a technology perspective or not from a regulatory perspective, but just from a market perspective, it was too far ahead of its time. But what you can see, and this is that downstream ecosystem, is once people start using these solutions, you'll find use cases for them. You'll find other things you can layer upon them. It's a chicken and egg problem. Where are we? And I do come back to this point, which is there's a lot of reticence to do things where you don't have regulatory clarity. So if you don't have regulatory clarity, you are always exposed. But Elliot pointed this out earlier. If you get a legal opinion that says, yes, you can do this, you are still exposed because it's just a legal opinion. It is not the regulator, for example, saying, yes, you can carry on this activity. So I'm back to my point. I think you need greater regulatory clarity in this space.
Thank you. I'm very conscious of the time. It's already 5 to 1 here in New York, and wherever you are in the world, it's 5 to whatever time you are at. And we have a lot of stuff to go through. So I'm going to ask everybody, if you don't mind, to try and keep it so we can get as much of this as we can covered today. Fairly short in terms of your responses. But I want to go into a question now. Eduardo, you and I discussed in our prep call, which I think is one of the keys. We haven't touched upon it yet, which is the whole corporate governance structure around tokenization, which frankly, from my perspective, is basically non-existent. We talk about regulation, but are we going to get any kind of corporate governance structure around tokenization of funds? And can the industry come together to do that? Over to you, Eduardo. So you brought up corporate governance when we had our prep call.
Absolutely. And so I obviously want to be respectful of the time of everyone. I think we pretty much killed that horse a couple of times already. So the reality is that for me, from the perspective of when you have no rules, those who know how to behave and understand the regulatory regime are the ones who will be able to innovate, and that therefore brings you back to governance. And there is very broad understanding of what's corporate governance, and then you can go very granular. But for instance, when I was working with HSBC, which I work with a SWIFT system, that's how I got into technology. One of the concepts that everyone even knows today, it seems like everyone here is at least contemporary to myself, some of you are not. There was in the concept that you had a check, for instance. And in a check, if you had a certain signature level, you would have double and triple signatures, and you would have to actually escalate these. The problem that happened, for instance, with FTX is that there was basically no corporate governance. There was one person controlling the keys, controlling the treasury, being able to transfer assets without having the separation of a trust account. And so when you do not build that from the start, and again, going to the same part of the question, the first question is, if you build it correctly in paper and you do it with professionals, with lawyers, accountants, and the proper banks, you will have a solid structure. If you think that you can do everything on your own, it's a recipe for disaster. So, that's my point.
I have to ask you this because there were some very large Canadian institutions, including Ontario Teachers, which must know how to do due diligence. They lost their shirt. Why, when they, how did that happen? They just forgot about corporate governance altogether.
Well, but like, that's 101, I mean, that's 101 for investing in any manager, like, you don't, like, ODD 101 is you don't invest in a manager unless there's dual signatory requirement on cash transfers out, I mean, like, so.
Absolutely.
Right. Unless anyone wants to say something particularly on that, because I want to keep cracking.
But that gets to my point, which is the parallels are, you know, what has to transpire in this world of future world of tokenization has to be parallel to the institutional world of that we currently live in. In other words, like, just as you would want a dual signatory on cash transfers, you know, maybe you need a dual signatory on, you know, in the context of where it applies here.
Separation of the assets, you know, you have someone.
May
that
have
is
come up with
essentially-
something, yeah.
Right?
You can be the signature for everything, Michael, yeah. Okay, I want to go to Kate. By the way, we've got 6 questions in here and I've only answered one of them. I'm not sure how many we'll get to. We'll try and, I'm talking as quickly as I possibly can. Here to, let's go to more of let's go a bit more granular now and talk about what you've been doing. So please outline developments on chain, in the on-chain infrastructure, including private permission areas, public versus private development, and Project Guardian, I think it's called, that you're involved in too. So this is maybe coming back to the question of fraud and is if you go into the private areas, there's hopefully that's not going to happen in the public area. That is happening still quite a lot. Over to you.
Okay, we'll try to be extremely brief. I think the best way for me to answer this question is to talk a little bit more about what JP Morgan's doing in the space. So back in 2020, we did 2 things. We set up a business unit dedicated to industrializing our blockchain-based offerings. And we launched a permissioned blockchain platform called Onyx Digital Assets, which effectively leveraged a permissioned instance of Quorum, which you can think of as very, very similar to Ethereum. Why we chose the route of building on a permission stack as opposed to a public stack, to address your first, the first question is, there are a couple of aspects to interacting with public blockchain that we as a firm are not yet comfortable with. The first is around the use of gas or the use of crypto to actually submit any sort of transaction. So that's deploying an asset, that's investing in an asset, that's custodying an asset. All of that within the public framework obviously requires a store of crypto. What is interesting from a development perspective is that there's actually been quite a few companies emerge that are called gasless providers that you can pay fiat cash and then they basically handle the crypto transaction for you. So kind of like intermediating an actor and the actual crypto transaction. But we're not quite there yet in terms of like even that addressing like our appetite for holding and transacting in crypto. So coming back to what we do, so we launched this platform, it's a permissioned blockchain platform on top of the blockchain layer. You can think of this as similar to like, you know, any other technology platform that has applications running on top of its stack. Like your iPhone has iPhone apps, AWS has like services that you can use when you interact with their system. So similarly, Onyx Digital Assets, which is the platform that I mentioned, we have an application that we launched, for instance, around intraday financing. We're basically being able to allow our clients to tokenize their assets and use those assets as collateral for cash lent by the bank and basically automate all aspects of that transaction from the time the trade is executed. We've continued on a mission to build out the application layer, looking at other forms of collateral mobility. And most recently, and related to what we're doing in this conversation, we're building out functionalities for issuing private funds and distributing those private funds directly on the Onyx Digital Assets platform. think your question, so just coming back to the infrastructure related question. You know, there've been quite a few advancements in, I think, the public space around, sort of, we just think about like what infrastructure is required for a sort of like thriving, fund ecosystem. Quite a few advancements in terms of like wallets, so how you actually like custody private fund shares, token standards. So this is really important because coming back to some of the key points that we touched on earlier, the true like value add of tokenization and blockchain-based systems is composability. So, you know, Chris issues an asset, I can create an application on top of that for like trading that asset, or another one for lending that asset, and it all happens on the same ecosystem. That only works if we're conforming to certain standards about how that asset is represented and how that can be interacted with. So that's another infrastructure, I'd say, gain in the last few years. The third, which is another large area of focus for us, and maybe the one I'll close out on to keep my answer brief, is all around identity. And I think this is where there's probably like the most room to continue to grow as more and more funds are tokenized, is figuring out ways in which you can standardize validating and reviewing the identity of investors coming into those funds, because that then drives that composability narrative even further of who can actually hold that fund share, how does it trade, how is it held, like all of that being questions that need to be answered around composability, but stem in how like the infrastructure itself develops around the ecosystem.
Thank you very much. That was a lot of ground you covered in a very short period of time. I appreciate you doing both of those things. Chris, we kind of have touched upon regulation already, but we do have a particular question we were going to cover today. What haven't we talked about with regard to that? And particularly the one bit we perhaps haven't is when do you expect change to happen, both in the US? Elliot was talking about your changes in regulation in Jersey at the beginning, and you touched upon, you know, the UK. What do you envisage will happen in the foreseeable future?
Well, I mean, the first thing to get your head around with regulation is not going to be any global standards. There's not any global standard or uniformity in relation to the launching and marketing distribution of private funds. You know, if you market into the United States, you know, you've got to be outside the SEC registration. There's a number of ways to do that. If you want to market into the EU, you have to comply with something called the Alternative Investment Fund Managers Directive. So it's a very, from a regulatory perspective globally, it's a very uneven and very jurisdictional, the specific landscape. And the obvious reasons for doing that is one, different governments think they do it, or different regulators think that they do regulation and protection of their own investors better than other people. You know, you listen to the SEC and you listen to the ESMA, the European regulator, you know, they all think they know better than everybody else. I think some jurisdictions rushed to introduce crypto specific laws and regulations when DLT, blockchain, crypto, call it what you want, came out. Some of those jurisdictions who chased crypto as an asset class have come a little bit unstuck. I think the EU came out with something called the Market and Crypto Assets Regulations. I think there is a danger of first mover disadvantage, but the EU, at least in the short term, they published those regulations immediately after FTX. And so suddenly they had first mover advantages. They had something that looked reasonably clear, treatment of stable coins, utility tokens, and tokenized financial assets. They said, well, actually, that just stays in our traditional, financial services regulation, something called MiFID. Where the question is, what will change? I think this will be an evolving process. You know, regulation is quite reactive. So long as no one loses money, no one passes any new regulation. People lose money, new regulation comes in. Getting ahead of the curve as a regulator is quite difficult because A, it requires you to see in the future, and B, you're very demand driven as regulators. People are crying out for new regulations on investor protection, the regulator publishes, but very few regulators peer unilaterally into the future and say, this is what we think the shape is going to be. So I'm a bit reluctant to say, oh, it's all going to change, in a year's time. I think you'll see what you've always seen, irrespective of the asset class, which people will bolt on bits, bits of regulation as this asset class develops. If indeed blockchain is an asset class rather than just a technology to facilitate trading of financial assets.
Thank you. In the interest of time, what I think I'm going to do, I've never done this before, because I notice we are beginning to lose members of the online audience. I'm going to read out the questions that are here. I got one killer question for the panel, which I might keep for the end. And you guys, if anyone wants to answer any of these questions quickly, then before we go to the killer question, then we can. So hold on, those of you who are online, we'll hopefully do this. And the first question: in research that IFI Global published late last year, family offices and high net worth investors were considered to be the likeliest investor category to use tokenization in the short term. Why is that? You kind of actually touched upon that in a way earlier in what you were talking about, but that's one question.
Well, I mean, I would just say that goes back to what I was saying before, which is institutions have boards that they're accountable to, family offices, high net worth. They don't have the same accountability, so they can take that risk if they want to.
Yeah.
Someone says, are tokenized investments a threat to traditional fund structures? Anyone want to quickly, yes or no? Yes, no, no, yes?
Well, one thing I didn't mention, I think what Jersey's doing in terms of this tokenization of funds, we didn't get to this, we didn't have time yet, I guess. I think that's brilliant. Like, that's a potentially great use of tokenization with a great end use in terms of for fund managers marketing funds in Europe. Like, I was with a fund manager running multiple billion in Europe, in London a couple days ago. And, because of the AIFMD and the whole passporting system, it's just too much of a hassle so like that would be a great use of tokenization, if it gains traction.
Okay. Is digital risk management keeping up with the advances, with all the advances, technology in blockchain development? If not, is this the industry's Achilles heel, digital risk management? That's maybe too complicated for anyone to answer in one word, I think.
I'd say no.
All right.
Blockchain is a complicated piece of technology, and the people who tend to be in risk management and compliance tend to be a little bit Luddite. For those who don't know what a Luddite is, it's someone who...
Your 19th century stuff again.
Someone who's resistant to technological change and used to break these weaving machines in the 19th century. Simon sold off as Ned Ludd. But the point is that you need people who are able to get up the knowledge curve in this asset class in order to do proper risk management in the space.
Okay. I'm trying to go through questions that haven't been touched upon. But I think what I'm going to do, there's one question: are we going to see boutique asset managers coming into this space? We don't think we've seen that yet, really, have we? Anyone want to?
Yeah, sure. I mean, of course you will. But again, they'll be boutique. The question is, what will matter more is when the JP Morgans and Blackstones and BlackRocks and the large institutions come in and clear the way for the smaller ones.
Okay. Right. Now, here's my killer question. I'm going to go straight to this and then we're going to end because we're losing people. Which is, what will be different about private fund tokenization in 3 years' time from today? So if we were sitting here in 3 years' time, early October in 3 years' time, what will be different? And if you want to give some numbers in terms of assets, that'd be great. But otherwise, what will be different? Let's just quickly go down the line. Eduardo, do you want to start? We'll quickly go down the line.
Well, I like to think that within 3 years, we're going to have a regulatory framework in the US. Clearly, one of the candidates is very keen on doing that, knowing that the largest asset managers and business we're, for instance, in communication with BNY, we know JP Morgan and Goldman Sachs are using the same sort of structures. And the Bank of International Settlements has actually provided some guidance on these. I believe that within 3 years, we would have probably at least double, if not triple, the amount of assets under management. And if you think about that in the continuous of the alternative asset class, which is being growing at a pace that is 59% CAGR, you know, like over and over, it's gone from 15 trillion to, I believe right now it's 30 trillion. You can see that that proportion of assets is moving quite rapidly. So I think that we are going to see an acceleration, especially when you have teams like JP Morgan moving forward with these type of initiatives.
Thank you. Philip, what will be different in 3 years' time?
You'll have greater expertise and greater use cases across the industry. I don't, you know, it's 3 years, 5 years, you know, these, like the timeframes, who knows? But what you are gonna see is greater use case, people actually putting these to work, and at somewhere along that curve, if you aren't in the space, you start being left out of
Yeah,
the
that's true.
conversation.
That's
So,
true.
you know, the people waiting to see, does this develop, and JPM actually pushing this, you know, the large players pushing this forward, moves everyone in that direction. So I think you're gonna have greater adoption over those 3 years, because you'll have to be in the space. You'll have to have the ability to deliver efficient information to your investors. When investors start demanding that they're going to get information in real time, you'll need structures in place, and if you don't have the experience, and if you don't have the infrastructure to do that, you'll increasingly be left out of allocations. I think that's a big thing that will happen over the next. 3 years.
That's a well-made point. Michael?
Yeah, I would just echo one point or not echo rather, make one point that I think hasn't been made, which is, I think there are some really good uses of tokenization, like, you know, very creative to tokenize funds so that they're then marketable in Europe, as Jersey's proposing, like that's good. But then I think there's some very bad ones, and I wrote a paper that Kai published on this called the token of the extreme. And you know, like tokenizing everything, buildings and collectibles and this and that. Like much of this stuff will just, one, there's not really a need. Two, it will become illiquid and it'll just end up with the illiquid markets, and then small high net worth private wealth family office will end up being distressed sellers, and distressed hedge funds will be the buyers and do very well and generate outsized returns. So like I've seen that pattern over the prior decades.
Okay, good point. Good.
I feel like Philip, I'm a little bit jaded by 3-year projections. But I think what I hope will be different in 3 years is definitely like the regulatory clarity point. And I think what will definitely be different in 3 years is there will be a lot more case studies as to which is the right path for private funds to follow.
Chris, last word with you. And
Yeah.
where will Jersey be in
Well-
tokenization in 3 years' time?
Hopefully, like everybody else hopes, more use cases, more products, more regulatory clarity. I think that the big point, and one we haven't discussed, is where in a matter of years will private funds meet retailization? Because the whole point, or one of the big use cases of blockchain is fractionalization. That means democratization. We've got a younger generation whose government's saying, oh, we can't pay your pension, you're going to have to save for your retirement from the time you leave school. They're on their phones 24/7. You can buy and sell crypto, you can buy and sell tokens all the time. So whether or not that opens up private funds to a more retail space, I don't know. Regulation will have to move, but that's one potential direction of travel.
Thank you very much. Thank you, all of those of you in the room who I see have been, I was about to say lunch starts, but you've already been getting into that. So well done to you for that. That's exactly what you should be doing. Those of you who are online who are still with us, thank you very much for following us. We will be having a recording of this, so there'll be that, and there'll be an answer on this as well. Have a great morning, afternoon, evening, or wherever it is, wherever you are in the world. See you the next time. Bye-bye, everybody.
It's really interesting.